Wall Street Wrap-Up is supported by Bamboolas, featuring live music. And now, tapas and wine upstairs. Bamboolas, the heartbeat of Frenchman Street.
This week on Wall Street Wrap-Up, it was a November to remember with stocks higher. But should we let it ride into December or cash in the chips and go home? Pfizer was trying to develop a pill to fight obesity. Well, they failed, and looks like they may be throwing in the towel. Tonight, we're going to be talking with George Ball, CEO and chairman of Sanders Morris Harris Investment Bank and former president of E.F. Hutton. George manages just under $5 billion of assets under management. And George was also the CEO of Prudential Beach Securities. So stick around for the next 28 minutes. This is Wall Street Wrap-Up. Hi and welcome. I'm Andre Laborde on this first day of December and the last month of 2023. But before we get to that, I wanted to make a correction from last week's show. We incorrectly had a slide shot that gave numbers to an NBC poll on President Biden's handling of the economy. The correct number of 1,000 registered voters has 38% approve of his handling of the economy, and just under 60% of those responding disapprove of his handling of the economy. Well, November ended yesterday, which is normally the best month of the year for stocks. And now going into December, which normally is the third best month of the year, all major stock indexes ended up for last month. The S&P ended up just under 9%, and the NASDAQ, they ended up 10.75% higher. And with that, technology still strong, and that was up overall 13%, followed by REITs, Real Estate Investment Trust, were up 11%, and retail possibly heading into the strongest month for that sector with the holiday shopping season for December. So why so strong? Well, the Federal Reserve is going to be meeting one more time this month for the year. And the feeling is that they will not raise rates, but have another pause. So we're going to ask our guest, George Ball, on his opinion tonight about his thoughts on this month's Federal Reserve meeting and if he thinks that they're going to be pausing or raising of rates. Well, the S&P closed today at just under 4,600. So take a look at some of the major investment banks and their thoughts on how the S&P 500 will be ending in December of next year of 2024. Deutsche Bank predicts that we'll be at 5,100. Goldman Sachs thinks that they're going to be reaching 4,700, and Morgan Stanley feeling that they'll be hitting 4,500. So with the November now in the rearview mirror, what's the roadmap for December? It seems that the trend is our friend. So why is patient investing in the markets more important than trying to time the markets? According to Dimensional Funds, the S&P 500 since 1926 has risen 72% of the time, almost 3 out of every 4 years. It's risen 20% or more 36% of the time, and 10% to 20% of the time, 21%. And since 1926, the S&P 500 has declined 10% or more only 13% of the time in the last 97 years. So it seems that the December before a presidential election is bullish. And on average, the S&P 500 is up for December at just under 3%. Well, how did our money do this week? It was the Dow Jones's fifth positive week for the week, and top sectors were real estate and materials, with Ulta Beauty leading the way. It was a 52-week high for the Dow Jones. Sector laggards for the week were communication services and energy, and losers today were Pfizer, Intel, and Netflix. And this week, Dow Jones, they closed just up 2.4%. The S&P 500, they closed up just under 0.8%. And the NASDAQ, they closed today for the week just up under 0.4% for the week. So coming off a great November for the stock market, how will December look? And what about next year, 2024? According to a CNBC CFO poll this week, half expect a recession next year, and 93% of those surveyed think that inflation has peaked. And just earning a higher than average paycheck, those consumers are feeling the pinch as well. According to a Lending Club survey, 8 million Americans earning $100,000 or more are living paycheck to paycheck. According to the New York Fed, consumers have added over $1 trillion in debt heading into the holiday season. And many investors are hoarding cash, waiting for a time to get back into the markets. So is the time right now? So when is the time? So with an estimated $5.5 trillion in cash or money market funds, so is this the time to get back in? Tonight, we're going to be talking with the CEO and chairman of Sanders Morris Harris Investment Bank, George Ball, with over $4.9 billion of assets under management. And George was also the former president of E.F. Hutton and the CEO of Prudential Beach Securities. Best of all, George is with us tonight. Hi, George. Welcome back to Wall Street Wrap-Up.
Andre, how are you today?
Doing great. You know, George, it's hard to imagine. We're on the last month. We're on the last quarter. We've gotten a lot of data coming out, everything from CPI, PPI. Job numbers for November is going to come out. But we're starting now the Christmas holiday season. How do you think the consumer is going to be for this holiday?
I think the consumer is going to either delight or frighten people by continuing to be very robust. The pundits in our business want to say that, well, the U.S. consumer has spent their excess pandemic savings. They are about to pull back. They're worried. They're concerned. But the fact of the matter is that the U.S. consumer is not daunted by higher interest rates. They aren't afraid of the economy, and they're actually feeling quite robust and productive. When people are being paid well, they will spend, they'll save some money, but they'll spend fairly liberally, and that's what's happening today.
I remember watching that going into this season, I saw reports from like MasterCard Plus and others on how much credit card debt that going into the season, the consumer already had. So do you think that this is just going to be adding on more to the credit card debt that they already previously had?
The short answer would be yes. If you look at the figures from a week ago's last Black Friday, consumer spending was up 5.8%. Online spending on Cyber Monday was up 7.5%. So yes, the U.S. consumer is adding to their debt, but I think not foolishly. Real wages are rising and are quite a bit higher than they were. And although people may have concerns, they feel fairly confident about their economic and job future in the early months, at least in the mid months of 2024. Things are quite sound and robust right now.
Next week is when the Bureau of Labor Statistics releases their jobs report for November, and that's when the unemployment rate comes out. Do you think for next week that the unemployment rate will be going higher? And depending on how you feel, do you think this will either put a fear of people either maybe having their jobs lost, or do you think that the season is just going to overtake all of that?
Unemployment may go up, but just fractionally. Right now at 3.9%, we're below what economists will generally call full employment. Full employment is anything below 5%. And the demand for workers is still close to twice as large as the number of workers seeking a job. So we're in a healthy, not once in a lifetime, but once in a decade situation where there are more workers wanted than there are workers wanting a job, and a slight uptick in unemployment, although likely, is not going to be a policy changer for the Fed or a mood changer for the household, I don't think.
We've almost finished now the ending of the reporting of the third quarter earnings that had come out prior, and now we're in the middle. We're, like I said, we're 2/3 over with going in the fourth quarter. And from what I remember is that something like we had something like 60% of earnings beat estimates, and something like 80% of revenue beat estimates. So the economy seems to be humming along very well. But we've also got, George, we've got a Federal Reserve meeting coming up this month in December, and we're going to have more in 2024. Do you think that these jobs, the job numbers for next week, the revenues that came out for the third quarter, do you think that the Federal Reserve is going to continue to keep pausing rates, or do you think that they may raise or cut? What are your thoughts?
Well, the Fed does have next week, the week of the 12th and 13th, their final meeting of the year. And I'm going to be both a middle of the roader and a contrarian looking ahead. There's a 95.5% probability right now that the Fed will not raise rates at this meeting. And I'm going to join that 95.5%, say nothing's going to happen to cause the Fed to raise rates. Most people think that the Fed will lower rates significantly during 2024. I don't think that's right. I think that there are two phenomena. One is American business and the American economy is adapting very well to what I'll call a 5% interest rate environment. It's not causing a shutdown of the economy or a recession. Secondly, the Fed isn't going to get rates down, the inflation rate down to 2% anytime soon. And I think the tagline to 2024 is going to be here for a year. The Fed funds rate at 5 to 5.25% isn't going to be cut during next year. If it is, maybe once by just a token amount. But we're in this interest rate environment, which is a fairly traditionally normal one, by the way, for the year ahead. So no rate cut in December and no rate increase in December and no rate cut in 2024.
I remember not that long ago, it may have been about 6, maybe 8 months ago, I saw an interview by you, and you had said, George, about you knew the Chairman Jay Powell of the Federal Reserve is not bluffing. He really wants to have that 2% inflation. Well, at the time, that was maybe 6, 8 months ago, so maybe inflation might have been maybe 6%, 7%?
7%, yeah.
Yeah. Now we're about, what, 3.2%. Do you think now that we're at 3.2%, close to the 2, around at 3, do you think that it's they may start to look the other way and become more of a dovish?
I think the Fed is on a glide path toward 2%. And a good pilot gets on a glide path to land the plane safely.
Yeah.
And then hopefully they'll need to deviate from it particularly. And that's what's happening today. The economic instruments to get us to 2% have been set quite well. What'll take a while longer is for households, for people like me and you, to get back to the place where 2% inflation seems normal, where the inflation expectation is at 2% rather than something higher. And that change in mentality lags economic reality by at least several quarters. So again, as I said, I think we're here for a year in terms of the Fed funds rate, and that's not apt to change.
I understand what you mean because, sometimes even though the data may say one thing, but it's that feeling of the other. And it's like what we talked about earlier, if you feel confident about your job, you're going to go ahead and spend. If you don't, you're not. What sectors do you like? Now that we're at, like you said, a 5 to 5.25%, when the interest rates were on a trajectory higher, tech is usually, or those type of sectors are bad because the higher the interest rate, those type of REITs get hit the hardest. Are there certain sectors you like?
I like tech. Tech is the hotbed of gains in productivity. Tech workers, tech companies are going to do very, very well. And you are actually, I think, going to see a broadening of investment interest beyond what's called the Magnificent Seven into other established but not yet gargantuan tech companies. So that's one area that I like. Second, and this is a contrarian opinion, the renewable energy stocks and companies have been battered. We're moving to renewable, sustainable energy. The companies in those businesses are going to be able to pass through price increases quite well. And I think both the industries themselves and the stocks over the next year or so are going to do much, much better. So technology broadly, not the biggest of them anymore, but the ones that are profitable. And beyond that, the renewable or solar energy companies that have been battered in many ways over the last year are going to see a renewal of interest and will do well.
You had given an interview and you were talking about some of those high-flying tech stocks that we think of a lot. You know, we think of Meta, or at the time the FANG stocks, or now the Magnificent Seven. And you brought up one stock I remember a while back, and you know, some of the unnoticed ones was like Teladoc or stocks like that. Do you so you like those type of stocks that may have been overlooked because the people were flocking to the Magnificent Seven kind?
People were flocking to the Magnificent Seven. Second, many of these large but not gigantic technology companies weren't profitable. They were looking to gain market share and clients' revenue growth, but they weren't profitable. The shift in investment emphasis has now come forward or backward, depending on how you want to term it, to, hey, you've got to make money. And so companies like Teladoc, by modestly increasing prices, by having more subscribers to their service, have shifted their focus from, well, how fast can we grow in revenue, to, hey, can we earn good money? And that's where I think there's some increasing value, a great deal of value in big but not yet scale-toppy technology companies.
Do you like the regular, when I say the regular energy companies, I'm talking about either E&P, exploration and production, or you're talking about Exxon, Chevron, Occidental Petroleum, things like that. The normal thought of what energy, your view?
I'm sitting in Houston, Texas, and so there's a lot of focus on energy.
You're going to get stormed.
If I say those companies are dust, I'd probably be garroted before I got outside the
like
doors.
Like storming of the Bastille, right? If you say something wrong.
With that said, excitement and investment's a bad idea. Boring is really pretty good, and so I tend to espouse, in particular, the master limited partnerships that transport energy, gas or oil, store this stuff, as being high yielding, so you're getting a very good return on your money currently, largely unassailable companies. Their contracts tend to be both inflation adjusted and to have a take or pay quality to them that are going to prosper, really, whether the price of oil goes up from 70 some odd dollars a barrel to 90 or down to 60. Their contracts, their revenues, their earnings, and their distributions are relatively assured. So they're not as exciting, but you get a darn good return while you're waiting. It's a very interesting and tax efficient way to approach energy investing.
Do you find that a lot of your clients, the investors, like companies like you talked about, MLP, master limited partnerships, those that have high paying yields?
Yield has come back into fashion, sort of like a necktie like mine. For 20 years.
They either go wide or thin, but you know, if you keep them long enough, George, you'll go right back.
Sooner or later, so everybody say, hey, that looks like did you just buy that yesterday? Well, it was
same as the lapels. I know.
Current yield has come back into vogue, and particularly current yield that has a component that's apt to increase year after year after year. That tends to be true of the master limited partnerships and and other companies. But the fear of inflation erosion is causing a re-emphasis of dividend or yield, and particularly when it is coupled with the probability of higher payouts in the years ahead. There's a shift in emphasis that I think that has been brought on by the hyperinflation of the last 2.5 years.
You know, one sector that I guess kind of surprised me a little bit for this week that's really been soaring a lot is the beauty of there's Ulta Beauty and e.l.f. Beauty. And you know, after a while I was thinking about it, I mean, let's say a housewife I'm curious, is beauty products the new food? So that, you know, if a housewife thinks, does she need more mascara or does she need more of a dozen eggs, that mascara or lipstick might be just as important as whether she goes to the grocery store. Is that sector one of those, like a recession-proof type of stock?
There's a good degree of recession resilience in the beauty stocks. There secondly is, by the way, and I can't remember it well enough to give a precise statistic, a high degree of seasonal positivism in the last month or so in the holiday Christmas time. That's a very strong or fairly predictable elevator of the beauty stocks. And thirdly, they are considered to be an affordable luxury. Now, don't ask me why affordable luxury is not a dichotomy, but still people view it as being something that if households feel prosperous, they will buy beauty products because it's not a lavish expenditure. You're not buying a Mercedes-Benz, but it is something that has a self-indulgent element to it.
It does sound a little bit like an oxymoron of affordable luxury, you know, for that. But it's something where, you know, like I said, mascara, lipstick, other types of things, and Ulta, those type of sector, that sector of Ulta and e.l.f. and others have been soaring
Yes.
during these times. You said one time, George, and I think I've got it right. And if you didn't say it, if you didn't like it, then you said, no, I didn't say it. But I think you said one time, the past is instructive, but not predictive. And you know, I'm thinking of, like, right now we're in the fourth quarter, and we're in the fourth quarter of a pre-election year. And normally, from what I've understood, is that the fourth quarter of the pre-election year normally is good. And so is normally the election year as well, too. Well, next year, we are having in 2024 a presidential election. What are your thoughts on that?
Twofold. One is the S&P is up 18% or so for the year to date. In years when the markets are up, the December performance is almost always very strong. Now, there's a very human reason for it. Portfolio managers, asset managers, and traders get paid a bonus on Wall Street. Bonuses often 60 to 85% of their total compensation. Think of a portfolio manager in Greenwich, Connecticut with a house with a large mortgage, and he's got good profits in his portfolio going into the end of the year. That individual will often buy more of the same to make sure that his potential bonus that's paid in early 2024 doesn't erode. That's just human nature. They're not buying things that they don't like. They're positions that are profitable and they do like. So there's a maintain my bonus effect, number one. As you look a bit further into the future, there, with the turning of the calendar, there tends to be a what's going to happen in 2024. I believe that there's more confidence that business and profits will be resilient next year than was true 3 or 6 months ago.
Well, you've been around the investment business for so long. I mentioned earlier that you're former president of E.F. Hutton. What's the best piece of investment advice were you ever given?
The best investors that I ever known look for one pivotal variable in an investment. They don't get distracted by the ancillary, the collateral, the non-essential parts of it. And they try to look at something that makes a company worth a lot more or not. in the renewable energy sector, there's a company that I'm thinking of. If I can mention one specific one, not as a recommendation, but just an example. Brookfield Energy Renewable Partners is a stock that's down a lot. They've got a whole lot of renewable energy investments, and those ought to do well if my thesis is correct about renewable energy is here to stay. So look for the pivotal variable. Don't look back too far, and look for something that others haven't appreciated yet.
George, that's a great place to leave it this time, but I hope you come back.
They enjoyed it very much, Andre. Thank you.
Thank you, George. Hey, if you've got a question, maybe a comment about the show, we'd love to hear from you. Make it concise, make it piffy, and write us at andre@benacapital.com. And now for a wrap-up on Wall Street. Disney is reporting yesterday that it's going to be reinstating its dividend after a 3-year suspension. The company announced a cash dividend of 30 cents a share that is going to be payable semi-annually to shareholders as of this January next month. Apple and Paramount are in talks of joining forces. Apple has the technology, Paramount has the film library that Apple would so desperately need. It's a marriage made in Hollywood heaven. And Pfizer they were trying to produce a pill form version of the Eli Lilly and Novo Nordisk's injection weight loss drug, but Pfizer has discontinued their phase 3 trials due to bad side effects. And on average, Pfizer patients were finding weight loss of between 8 to 10% as compared to Mounjaro by Lilly. That weight loss was around 20% weight loss. So if you enjoy going to Panera Bread for lunch or maybe for dinner, well, you maybe like to own the company. Panera Bread is filing an IPO or an initial public offering to go public early next year. And that's a wrap-up on Wall Street Wrap-Up. Join me next Friday. The Bureau of Labor Statistics is going to be releasing November's jobs numbers and their unemployment rate. So how will these numbers affect December's Federal Reserve meeting for interest rates? Next week, we're going to be talking with the managing partner and the chief investment officer of the Bahnsen Group, David Bahnsen, with over $4.5 billion of assets under management. Does he see a December matching the returns of November? How does 2024 look? And where is he investing his money? So we can find out too. That's David Bahnsen, Chief Investment Officer of the Bahnsen Group. Our thanks to George Ball for being with us tonight. But as always, we always appreciate you for allowing us into your homes this evening. Have a fun weekend with the ones you love and a happy shopping this weekend too. Remember, if it's Friday, it's Wall Street Wrap-Up. I'm Andre Laborde. Also remember, money never sleeps. Good night.
Wall Street Wrap-Up is supported by Bamboolas, featuring live music. And now, tapas and wine upstairs. Bamboolas, the heartbeat of Frenchman Street.